Welcome to This Explainer. Today, we're cracking a classic business mystery, unlocking the strategic secrets of marginal costing. If you've ever wondered how top-tier managers make those rapid-fire decisions on pricing, production, and profitability, you are exactly where you need to be.
Think about this for a second. How did businesses know when they can slash the price of a product, offer a massive discount, and somehow still walk away with a profit? It sounds completely counterintuitive, right? Like, why on earth would a company drop its prices below its total production costs? Well, today, we're going to put on our detective hats and figure out exactly how companies pull this off without going bankrupt.
Here's our quick roadmap for this explainer. We'll start with the marginal costing concept, move into the contribution margin equation, compare marginal versus absorption costing, look at smart managerial decision-making, and wrap up with the limitations of marginal costing.
Okay, Section 1, the marginal costing concept. Let's dive right in and identify the two main suspects in our pricing mystery.
To solve this, we absolutely have to separate our costs into two very different buckets. First, we've got fixed costs. Think of these as a brick wall. They don't budge. Whether you make one single unit or 10,000, things like factory rent stay exactly the same for that period. Then on the flip side, we have variable costs. These are entirely flexible and change directly with your output. More production literally means you're spending proportionately more on raw materials and direct labor.
And that brings us to the main event, marginal costing. This is basically our financial magnifying glass. It lets us zoom in on the true cost and profit effects when our production volume changes simply by strictly separating those fixed and variable costs. By pushing the fixed costs aside as just period costs, we can see exactly what producing one single extra unit actually does to our bottom line.
Let's move to Section 2, the contribution margin equation, and see how this perspective turns into a really powerful mathematical tool.
Now don't worry, we aren't going to get bogged down in complex algebra. Just look at this wonderfully simple progression. When you take your total sales revenue and subtract only the variable costs, literally ignoring the fixed costs for a minute, you're left with a very specific pool of money. We call this the contribution.
Let's make this totally concrete. Imagine you sell a product for 30 rupees. The variable cost, so the materials and labor to actually make that specific item, is 20 rupees. That means your contribution per unit is exactly 10 rupees.
But hold on, that 10 rupees doesn't go straight into your pocket. Not yet. That total contribution gets pooled into a sort of central fund. From that fund, you first have to pay off all your fixed costs, like your rent. Once those fixed costs are fully covered, whatever is left over, that becomes your actual finalized profit.
Up next, Section 3, marginal versus absorption costing. The key here is understanding how this fresh way of looking at the income statement differs from traditional accounting. Here's where we see a massive divide. Traditional absorption costing takes those fixed overheads and bakes them directly into the cost of the product, which means they end up in your inventory valuation. Marginal costing, though, it completely strips out the fixed costs and treats them merely as period expenses. So, under marginal costing, those boxes sitting in your warehouse are valued purely at their variable cost. So why does that actually matter? Well, because absorption costing ties fixed costs to inventory, simply having extra unsold stock sitting around can artificially inflate your reported profits for that time period. A chunk of your fixed costs is basically hiding inside that unsold inventory. If you're a seasonal business with wildly fluctuating stock levels, absorption costing can give you some highly odd, even misleading profit results. Marginal costing cuts right through that illusion.
All right, Section 4, smart managerial decision-making. This is the real climax of our explainer, where we take this out of the textbook and apply to a real-world scenario.
Let's put you in the hot seat. You're the manager of XYZ Your factory is currently running at 70% capacity. Normally, you sell your product for 120 rupees. Out of nowhere, someone offers to buy a bulk order of 20,000 units, but they only want to pay 70 rupees each. Your accountants are telling you the total cost to make one unit is 90 rupees. What do? Do you reject it? If you're relying on traditional absorption costing, you probably slam the door on this deal instantly. You see a total cost of 90 rupiah, which is made up of 60 in variable costs and 30 in fixed costs. Selling at 70 rupiah looks like a massive 20 rupee loss on every single unit. It seems like a total no-brainer to walk away. But wait, let's look at it through the lens of marginal costing. You realize that your fixed costs of 21 lakh rupees, they're already fully covered by your regular day-to-day sales at that 70% capacity.
Producing these extra 20,000 units only triggers the variable cost, which is just 60 rupees per unit. Since the 70 rupee offer beats your 60 rupee variable cost, you're actually generating a 10 rupee contribution on every single extra unit. Multiply that out and your total profit magically jumps from 21 lakh to 23 lakh. You just spored a 200,000 rupee boost to your total profit, all from an order that traditional accounting said was a loss.
And this isn't just a one-trick pony for special orders. This exact framework is how savvy managers survive trade depressions. They price just above marginal cost to minimize their losses when full cost recovery is off the table. It's also the secret sauce for deciding whether to manufacture a part or just buy it, optimizing your sales mix, and knowing exactly which failing products to drop without accidentally wrecking your bottom line.
Finally, Section 5, Limitations of Marginal Costing. As amazing as this tool is, we definitely need a reality check.
The math here relies on some pretty heavy assumptions. First, it assumes you can flawlessly split mixed costs into neat fixed and variable buckets, which honestly is notoriously tricky in the real world. Second, there's a serious danger of under-recovering your fixed overheads. If you price at marginal cost too often, you're eventually going to bleed out from unpaid rent and salaries. Third, it technically undervalues your inventory compared to standard accounting rules. And lastly, it assumes your variable cost per unit never changes, totally ignoring realities like bulk discounts or labor shortages.
Plus, we really have to look at the future. Modern technology is completely flipping the script on how businesses operate. We're seeing variable human labor getting replaced by massive, expensive machinery. That means fixed costs are skyrocketing, while variable costs are dropping dramatically. So, as we wrap up this explainer, I want to leave you with this thought. If automation and AI push variable costs down to almost zero, while fixed machinery costs absolutely skyrocket, relying on a system that mostly ignores fixed costs becomes pretty risky. Will marginal costing become a relic of the past, or will financial detectives just evolve the equation for tomorrow's automated economy? Thanks so much for diving into the mechanics of marginal costing with me today.